think there's two very important takeaways from recent events, particularly with SVB. The first being that banks need to aim for something higher than just meeting the regulatory requirements. They need to aim for industry best practices in their risk management and governance frameworks, but also that regulators need regular information so that they can intervene when necessary if there are troubles at banks. I think there's lessons to be learnt on both sides here, both from the bank side and from the regulator side. From the bank side, there's definitely a need for much stronger risk and control governance frameworks, more than just the minimum requirement from the regulator. But then also from the regulator's side, there's a requirement on them, or for them, to be able to obtain information at a regular interval, so they can intervene or they can provide suggestions as required in the event of an emergency. So the first point is really about data quality. And with any reporting system or modeling system, poor data in results in a poor model output. So the same thing happens with any sort of reporting. Starts with data quality, moves through in terms of automation and trying to increase the ability to generate reports on a more regular basis because of that automation. Less reliance on human involvement and more focus on that straight-through processing from the data aspect all the way through to the final report or management information product. So I think the most important part about this is that management needs to be informed before they can make decisions. A big part of that is then reporting. Management need to have all of the latest information available to them to be able to make those informed decisions. That can be either through regulatory reporting or internal reporting metrics that they've developed themselves. But both of these options require robust data and systems, but then also an internal desire to have that information and to utilize it for those management decisions. So the bank needs to structure the way they approach risk and governance in a way that obviously meets the minimum requirements from the regulations, but then also considers best practice from their business perspective. They need to consider the impact that this will have on both the customers, but also their shareholders. So they need to go and aim for a higher level of compliance than what they currently have. So there's a number of different factors that are going to go into what the banks need to do to step above and beyond the minimum regulatory requirements. Some fundamental pieces talk about succession planning. So SVB in particular was without a CRO for over a year. That's hard to state that they have good risk management when there is no chief risk officer in the organization. So succession planning is a big part of that from a management perspective, but then also incentivizing management in the right way is very important. When you choose not to hedge certain instruments in the pursuit of profits, there needs to be an assessment there as to whether that is both a good idea from a shareholder perspective, but also from a risk management perspective. Where does that fit within the risk appetite of the organization and what the shareholders are expecting, but also protecting deposit holders. Ultimately, they are the ones that could bear the cost of this more so than shareholders who have a known risk appetite for investing. They expect a return based on how much risk the bank is willing to take.